This is the Landlording for Life podcast, where landlords explore their success and stories of failure while building a foundation to improve upon. Here's your host, Sean Morrissey.
Hey everybody, welcome to the Landlording for Life podcast for this week. This is your host, Sean Morrissey, and thanks so much, as always, for tuning in. Now, today we have on the line with us a gentleman by the name of Paul Moore. Now, Paul is with Wellings Capital, and he's also the author of The Perfect Investment, which is ultimately a book that discusses why multifamily housing is the perfect investment for landlords and aspiring investors. So today, Paul's going to kind of go into some detail in regards to why multifamily homes are the perfect investment, and we'd love to welcome to the show. So Paul, welcome to the podcast.
Hey, thanks, Sean. It's great to be here.
Awesome. Yeah, thanks for being on. So, Paul, tell us a little bit about your background, how you evolved into multifamily, and kind of where you're at today.
Okay, great. Well, so I got an engineering degree, which was a mistake, and then I got an MBA from the Ohio State University, and realized I really loved marketing. So I went to work at Ford Motor Company in a non-marketing job, and I worked in the customer service division for about 5 years. It was awesome. I actually got to work in your fine city for a while on North Avenue in Chicago.
Awesome.
And but really just felt a burning desire to be an entrepreneur. And so I started my own company along with another guy at Ford, and it was an HR outsourcing firm. And I was really honored to be a finalist for Michigan Entrepreneur of the Year in years 3 and 4 of that company, I think it was. And then in year 5, we sold it to a publicly traded firm. And I decided to move my family to the Blue Ridge Mountains of Southwest Virginia. I had 2 kids, and Detroit was imploding at the time. And just really felt like this was not a place I wanted to raise my kids. You know, Detroit's bounced back a lot since then, but that was about 20 years ago. And, retiring or semi-retiring, I guess, at age 36 sounds really glamorous and fun. It was miserable because I was, I was an entrepreneur at heart. And so I started all these businesses. I started a nonprofit organization or 2, and I did all this stuff just kind of trying to find myself again, because I kind of at the time used to think my value was on how much I could produce. And so started lots of businesses, but eventually that led me to house flipping. And a buddy of mine who was kind of bored as well, he and I started flipping houses before that was a thing. And we flipped our first house. We actually went to the courthouse steps on an icy day in December, and we were the only people there. And we said, if this house goes below $50,000, somebody should buy it because it looks like it's worth $65,000. Yeah, this is a different market from Chicago.
Yeah.
Me. And so it actually came out. They rolled it out at $32,000 or $34,000, and so we snagged it up, and we painted it, cleaned it, and put it back on the market in 3 weeks for $65,000. Sold it within 4 hours to somebody who drove by. And we thought, wow, we just made like $25,000 net in a few hours work. We can do this, like we can do one a week. Well, okay, that was supposed to be a joke.
Yeah.
But seriously, we thought that. And so we got into house flipping, and I went from there to building houses and then subdivisions, built a multifamily facility in North Dakota, worked in copywriting, actually kept gravitating back to multifamily. So I've been doing multifamily the last couple of years. And so we actually did a Hyatt's based in Chicago, of course. And we did a Hyatt hotel that was actually a major failure because we picked the wrong location, wrong market. So that was a huge lesson. But never want to get into development again. I really love the idea of buying existing multifamily, improving it, improving the value, and providing a great return for our investors. So that's where we're at.
Awesome. Well, I think what's important to note there is really, you wrote this book, but what came prior to it was really experiences all over the housing industry, right? So at the end of the day, it seems like you kind of evolved into learning that multifamily was the way to go. Is that fair to say?
And I think a lot of the other things I did were great. They just weren't great for me perfectly, personally. I mean, I made 55% profit on my development, and another one I helped with, the guy made like 200 or 300, 400%, I'm sure.
Awesome.
And so I think that's a great thing. But I've noticed that ground up developers of all types are some of the wealthiest people in the world, or sometimes they're delivering pizzas. Because, I've realized that risk and return is it's a funny thing. We think that riskier investments produce higher returns, but here's the truth. They produce the potential for higher returns, Sean, which means they also have the potential of higher losses. And so what I realized is I wanted to stop speculating and gambling. I wanted to start investing. And I see the difference as this. Investing is when you have principal that's generally safe and you have a chance for a return. But I see speculating as when principal is completely at risk and you have a chance for a return. And I speculated for years and I lost big time, several times. And that was painful. I thought when I was in my 50s, I thought, I think I want to stop. Once I realized the difference, I want to stop speculating and I want to start actually investing. And so that's what I'm doing now.
Okay, very good. And it's funny. I mean, I was going to say this is a great segue to our next question, but I think you're already starting to answer it. And that's why, that's ultimately why is multifamily the perfect investment in your eyes? And I guess it starts with that speculation level, correct?
Yeah, I think that's one of them. I mean, the risk and return of so many things is just, I'm not knocking my friend who just bought a $2 or $3 million house for cash in Atlanta with Bitcoin profits. I'm not jealous. No, I'm just kidding.
Yeah, me neither.
No, seriously. He did a great job, and he saw the trend. He saw it coming years ago, and he made millions, maybe tens of millions. I don't know. And he's only in his 20s, and I'm really proud of him. It's a guy that I helped mentor, but seriously, those type of things can go up and down. And the problem is that the value is not related to an objective measurement. And what I mean by that is cash flowing properties that can be rented, properties that have a rental income stream, they have a known value that the market, decides. And it's a little variable. I mean, it can go up or down based on the cap rate or the supply and demand in the market, but it is a known value because it has a known income stream. And things like gold, which I used to invest in and lost money a couple times, made money a few times, and other things like that, they don't have an income stream, and therefore I consider them more speculative in nature. Multifamily, I think I can just go through it real quickly. I think that the reason we called it the perfect investment is it has incredible demographics. We can look down the road decades in advance and see what we believe the trends are pointing to as far as the market. And baby boomers, which is the second largest generation in history, are the fastest growing rental market because we realized that, that our home was not the perfect investment. And we were told, by our grandparents and parents, get a home, pay it off. That's the perfect, way to build your nest egg. But a lot of us found out in the last, 12, 13 years ago that when things crashed, the home wasn't the perfect investment. So baby boomers are moving toward rental property in droves. And statistics say when they eventually rent a home, they rarely ever go back to owning again. Second group is millennials. And of course, millennials have record student debt, a desire for flexibility, and a desire not to be tied down to a seemingly overpriced house with a 30-year contract on it. And so they generally prefer to rent more than own. Yeah. And then, of course, you've got the effective immigration, and immigrants by far rent more than owning, especially the first number of years they're here. So those three factors have caused the and some government tampering that went awry in 1995 to 2005 caused the ownership rate of housing in the U.S. to drop from 69.2% down to 63 or 64% now. And if that trend continues, we don't know if it will, but if it does, we could end up like Germany that has a home ownership rate in the 40 to 45% range. So the demographics point toward it. And the fact, like I said, there's a known income stream when you're buying Class B stabilized multifamily. You can already know that there's an income stream. It's spread out across hundreds of units in some cases, so it's not like owning a single home and banking everything on that. Where if you have a vacancy, it's 100% vacant, right?
Yep.
But anyway, there's a significant number of other factors where the risk and return balance out. The perfect measurement for this is called the Sharpe Ratio. That's spelled SHARPE.
Okay.
And the Sharpe Ratio measures the return versus the risk of all kinds of different asset classes. And it has multifamily and storage units at the top of the return versus risk. And it's much, much higher than the Dow Jones Industrial Average and private equities, and then other commercial asset classes, which are generally quite a bit lower.
Okay, very good. So I have not heard of the Sharpe Ratio before. Where's the best place for folks to find that? Should they just simply Google it, or what would you recommend?
We had a really hard time finding this statistic, and we actually ended up having to rebuild it ourselves.
Is that right?
Using the Sharpe formula that was developed in the 60s, I think. Okay. We had to rebuild it ourselves. But you can Google it and look for it. I talk about it quite a bit on my Bigger Pockets articles as well.
Okay, very good. So landlords aspiring to be the multifamily investor, because I do believe, multifamily, there's a lot of talk these days that you can go from 0 to 60 in 5 minutes, right? As a landlord per se.
Yeah.
And I feel like it's something you actually have to evolve into, because ultimately you've got to have your property management systems in place, or you got to have the people in place you can trust to take on some of these bigger projects. So with that in mind, and to our listeners out there, what would you recommend our listeners be looking for in a multifamily purchase? How would you recommend they evaluate that type of purchase prior to closing on it?
Well, there are 3 levels of multifamily. There's residential multifamily, which is, typically 2 to 4 units. That'd be a duplex, triplex, or fourplex. And you can get a residential loan for that. The problem is those are valued based on the comps in the area, like other houses.
Correct.
And so you can't force appreciation through value add changes. I know I just threw a lot out there, but you can learn more about that on Bigger Pockets or in my book, or we can talk about it in a little bit. But then there's small multifamily, which would be considered 5 to about 75 units. I know it doesn't sound real small. And then 75 or 80 units and above is considered commercial multifamily. And the benefit of this is you can have an on-site property management team, and you get a non-recourse loan. And so non-recourse debt, of course, is the holy grail of lending when it comes to the multifamily world. So I would look at the possibility of trying to get if someone's committed to multifamily, I would try to get up to that commercial multifamily level as soon as possible.
Okay, so 75 plus units in essence.
Yeah, there's in urban core areas. I mean, I'm sure that in places like downtown LA or New York or Chicago, that might be a much lower number. There might be a full-time property management team at maybe 40 or 50 units. But in your general suburban markets, it would be 75 or 80 units or so and higher.
Okay. So at the end of the day, the moral there isn't necessarily the number of units. It's ultimately having the ability to hand, let's say, the management systems off to a full-time staff, and then the non-recourse end of it. Is that fair to say?
Yeah.
Okay.
So that's right. Mm-hmm.
Okay. So that's what we're shooting for. Okay. Very good. Now, part of what you talk about in your book is in essence, finding a deal partner. And I was hoping you can comment on that a little bit in regards to the best ways that investors should be, building their network, or I guess relationship capital, to find those deal partners. What kind of comments might you make there?
So what I talk about in the book, Sean, is that it's very hard for the typical person to get to the level of commercial multifamily where I just told people they should go. One of the reasons is brokers don't take you seriously. Another reason is it's very, very hard to get a loan if you're a newbie. Another reason is the net worth and liquidity requirements are really high.
Yep.
And number 4, just the simple fact that it's very hard to operate if you haven't done this before. So I recommend finding a mentor, and a mentor would be somebody who has already involved, in commercial level multifamily, and I would recommend partnering with them. Now, the ways to partner with them there's a whole bunch. There's about 5 different ways. And one way is to be a deal finder. If you have a unique nose for deals, and I run across people like this on Bigger Pockets and other places sometimes that just seem to be able to come up with off-market deals, or they happen to know a lot of owners of multifamily that don't want to go to the market to sell. Well, take that ability, take that relationship network you have, and go offer it to a multifamily syndicator, and basically say, look, I'll bring you deals. You give me 5, 10, 15% ownership. 10% is kind of standard, I think. So that's a great way to partner into the multifamily realm. And then you say, look, I want to learn the business as part of this. I want to be on, I want to be on the phone calls, and I want to go to the site, due diligence, etc. Another way is if you have an investor network. Now, this is really scary area because the SEC regulates this really carefully, and you can't just, sell your investment leads and get a commission. But you can partner with a company and say, look, I've got a couple $1 million in potential investors. I'd like to partner with you on your next deal. I'd like to be part of the general partnership. And you can possibly find multifamily syndicators who would be willing to do that and allow you to partner with them, and you bring, some of the money, as long as you're significantly involved in the, in the process and in the operation. Another way to do it would be just to get a mentor. And that may sound like it's not really a partner, but there are companies out there that I can mention if you ask me, who are willing to mentor students and then bring them through the mentoring program to the actual place where that student is able to buy a multifamily property or partner with them on a property, and they can learn the business and get their resume to the next level by partnering with their mentor.
Well, and I tell you what, Paul,
at least 3 or 4 like that.
Yeah, and I tell you what, let me interrupt because let's share with our listeners maybe a few you might recommend that are good resources when it comes to mentoring.
Yeah, one is a company out of Richmond, Virginia, called 37th Parallel, and they're also called they have a name for their mentoring program, but you can look up 37th Parallel. You can Google that or go to 37parallel.com. Another one is Joe Fairless, and a lot of people know who Joe Fairless is from podcasts and his mentoring work and conferences, things like that. And a third one is Reed Goosens. Now, Reed is spelled Goossens. The first name's Reed, R-E-E-D. Reed's from Australia. He's a great guy. I met him in LA a few weeks ago for breakfast, and I can tell you that his students seem to be really thriving. He mentors them, and he allows them to be part of his deal.
Okay, awesome. And you know what? I'll throw one more in there. There's a podcast that I follow from time to time, Michael Blanc. He does some mentoring as well as partnership programs, and has a fantastic syndication spreadsheet too that I've used, and big fan of his stuff as well. Michael Blanc's students are doing really, really well right now. In fact, they're closing on yet another deal in Memphis as we speak. Is that right?
And
okay.
His students are part of that. So yeah, I should have mentioned Michael. He's a friend and a great mentor.
Yeah, fantastic. That's great to hear. So let's transition over to the financing side of things. I was hoping you might have a few comments when it comes to financing your first multifamily deal. Either types of financing that might be helpful or resources we should look into prior to taking that jump.
Well, a lot of people really try to get owner financing, and if you get a property that is either run down or heavily vacant, or it's just been mismanaged, sometimes you can get the owner to do owner financing, but you're going to have a heck of a sales job convincing them, if you're fairly new, that you can turn this property around. So you better be ready for a lot of work. and a really good sales job with them. Another way to do it, of course, is through a CMBS loan, which is your standard loan. That's sometimes those are recourse, sometimes they're non-recourse. And then, of course, there's Fannie Mae and Freddie Mac loans. And they actually have a small balance program, Freddie Mac small balance program. And there's a company that I'm trying to remember the name of right now, but I think it's SOBAL are their initials. Yes. But it's small balance loans from Freddie Mac. And that might be, their requirements are less. And the small balance program for Freddie Mac has lower requirements to get in, lower net worth and liquidity requirements, lower paperwork. It's lower cost fees. I'm getting going. And I think it's trying to help people, get started in the business or buy some of these smaller properties that are generally considered less desirable. I don't know the exact range, but I believe the loans for small balance run something like $1 to $6 million.
That sounds about right. Yeah, going back a few podcasts for us, we hosted a gentleman by the name of Paul Winterroud with Bonneville Multifamily, and he spoke about small balance and that program a little bit, or at least provided resources. But, I don't know anything about the CMBS loan. Are you able to expand on that program at all?
I believe it's commercial mortgage-backed securities, and these are loans which are pulled together by investors and packaged up and sold on the market. So they might, pull maybe 20 or 50 or 150 loans into a package. And these, there's some people feel like they're I hate to say this, but last resort if you can't get a Freddie Mac or Fannie Mae loan. Because there's all kinds of restrictions, I guess, and I guess it's a lot harder to refinance or sell that to a buyer. So I think people should look really carefully into that. The truth is, as you can tell from me stumbling around here, Sean, I don't know much about CMBS. I just know it's out there.
Yeah, no worries. Yeah, as long as it's on us to Google those things after the show, right? And look into them further. So all good resources. We appreciate it.
My thought exactly.
Provide the resources and then go and do your homework after the show. Okay, well, let's talk a little bit about where the multifamily market's at today. I mean, I can speak to the Chicagoland area and say, man, it is on fire. Especially, anything that would be considered what you'd stated like in the small commercial or multifamily area. I certainly see it on fire. How about yourself? What do you see out there today? Where do you kind of see it going?
Oh, it's painful. Yeah. That's a painful topic. We are, all my partners and I are in our 50s. We all decided that we don't want to take significant risks with our money or our investors' money. And we've all lost money on deals in the past. And so we decided that we're going to be super conservative, super careful, which means we're not willing to invest in a lot of deals right now. And the part of the problem, there are 4 or 5 factors, which I could try to buzz through quickly, that have caused the market to be overheated. I don't know that it's in a bubble. And of course, all real estate is local. So, maybe in Santa Monica or Sacramento, California, it's not a bubble. And it could be in LA or, Chicago. But some of the factors are there's a lot of international money coming in. I know of a Chinese investor group who said, we don't care if we even make a profit. We're willing to break even just to get in to the U.S. dollar into some commercial real estate investment. So think about that, Sean.
Yeah.
How do I compete with somebody who's willing to break even?
Yeah.
That means when I'm bidding $15 million for an apartment and I expect a 10% return from my investors, they might be, I don't have the exact number, but they might be willing to pay $17 million for that same property. And I can't do that.
Yeah.
And so that's a real problem. A second reason is a lot of people are selling their properties right now, and they're using 1031 exchange money, which is tax-deferred money, and they're willing to take a little bit lower return just to save the taxes. And a third related group would be IRA money. people who have, let's say hundreds of thousands or millions in IRAs, and they're willing to be just slightly less discerning, in some cases, not all, with what they invest in. And when they do that, again, it causes people to overpay. A fourth group that overpays is, I guess you could say, driven by syndicators who are really, really in it for the fees. They really care more about, getting a deal done, getting something done. They've got investor money waiting to invest, and they get an upfront fee and then an ongoing fee for managing it. And they're not necessarily as concerned with the return to the investors, which, let's be honest, that can be unethical, but they're willing to do it, and we have to compete with them.
Yeah.
So it's just a really difficult time to acquire assets right now, and it's causing us to scratch our heads and try to figure out what to do next, because we had 52 investors on our last deal, and a lot of them are wondering, when are you going to do your next deal? I'm waiting, and we're just not sure what to tell them.
I think those are all fantastic points. And the one that kind of strikes me is that the syndicator's in it for the fees. And, not to say the crowdfunding space is creating that in any way, shape, or form, but the crowdfunding space is creating competition for the syndicators, where I would think that's right. Again, that's going to play into it and, perhaps create an overbid type of scenario. So it's, it's a little tricky out there. I mean, what are you guys doing are you looking for off-market type of transactions, going to folks that might have the potential to sell, or what would be some ideas there to find the next deal?
Yeah, we're working with deal finders, which I mentioned earlier, to try to find off-market scenarios, or brokers who have clients who, for whatever reason, don't want to take it to the market. That's one thing we're doing. The second thing we're doing is we're considering the possibility, we haven't done it yet, of partnering with other operators that we know who either they have some kind of line on multifamily deals that we don't have, and or they actually are experts in another asset class, and that would be something like maybe storage units or mobile home parks. And like I said before, we've never done this. We never wanted to. I mean, after all, I called my book The Perfect Investment, right?
Yeah.
But we're wondering, should we consider something that's a little less overheated right now? And maybe we should just partner with them and trust their track record and trust their integrity. And maybe we should consider co-investing with them. So that's what we're doing right now, to be real honest.
Okay, cool. No, I appreciate you sharing that with us. So Paul, one of the three questions we ask all our interviewees is a book they might recommend to listeners, something that may have changed their life or might ultimately help them aspire to the next level. We were hoping you could comment on that. What would be your thoughts?
So a book in general would be The One Thing by Gary Keller and Jay Papasan.
Okay. And
a lot of people talk about that book. I had Jeff Woods on my podcast a few days ago. It's not released yet, but he's the head of the One Thing organization and podcast. And so really diving back into that for the third time in my life right now. And then for apartments, there's a book that's not super well known, but it's a great book. It's called The Complete Guide to Buying and Selling Apartment Buildings. And that's by a guy named Steve Burgess. That's Berges. Steve has amazing stuff in his book, and it's so well done. There's one thing I wouldn't agree with, and that's the timing of the investments. I mean, he talks about getting in and out of investments in 1 year. I mean, basically, you get in, you fix it up, you re-tenant it, and then you sell in a year, and you buy the next and the next and the next. And I know a guy who used that strategy over 27 years, I think it was, 27. Okay. And he went from a duplex all the way up to an $11 million multifamily, and he just kept trading up. But he probably had 3 to 4 years between trade-ups, and I think that's a lot more realistic than every year. Other than that, Steve Burgess' book is great.
Okay, awesome. I have not checked that one out. I'm going to have to do that after the show. So what about a piece of advice you might provide to aspiring landlords? What's something that might be passed along from you to them?
Well, I'm actually becoming a Warren Buffett fan. I didn't know all that much about him over the years, but I'm actually writing a series of articles for Bigger Pockets right now called, basically it's Warren Buffett's advice for real estate investors. And Warren said, it's better to buy a great company for a fair price than to buy a fair company for a great price.
Huh.
And I thought, okay, wait, how does that translate to real estate investing? And here's how I would say it. It's better to buy a wonderful property in a wonderful location at a fair price than to buy a fair cash flowing property at a wonderful price. And I think that if you and your listeners think through that, you'll realize, you might be able to get something, in a ghetto for a fraction of the price of, buying something in, South Barrington or some nice suburb, Naperville or whatever.
Yeah.
But you will have so many headaches. You'll pull your hair out and you'll end up going into a different business if you don't be careful. Now, obviously, there are people who survive and thrive in those very, very difficult markets. But I'm telling you, those people are few and far between. So that's my advice.
Good stuff. Something to think through. All right, Paul. Well, I'll tell you what, if our listeners were looking to contact you or maybe follow your podcast or check out your book, what would be some different means that they should reach out, or what should they look for?
Well, thanks for asking. So we've got a book called The Perfect Investment. It's available at our website, wellingscapital.com, or you can just go straight to Amazon and order the book. There's going to be an audio version out soon. I'm actually recording that this week. And as far as our podcast, we have a wealth building podcast called How to Lose Money. And the show is talking to, on the show, we talk to successful investors, entrepreneurs, business people who have lost significant amounts of money, time, or relationships in the past. And we talk to them about why it happened. We help them process their pain, believe it or not. And we actually talk about lessons learned so that we all don't make the same mistakes.
Oh, fantastic. I have not checked out your podcast, but anything that relates to experience and something we can pull from that is certainly worth a listen. So appreciate you providing that value to folks.
Absolutely. We'd love to have you on the show, Sean, if that's something you've ever experienced.
Oh, absolutely. I'm looking forward to it. And especially if I can learn in the process from my mistakes, that always helps.
Right.
So, Paul, that's going to conclude this week's podcast. I really appreciate you being on the show. I think you supplied a ton of ideas and value to folks that might be looking to scale up to the multifamily investment. So we really appreciate it.
It was really great. It's a great honor to be on here, Sean, and I really wish you the best with your podcast, your business, and look forward to chatting more in the future. Thanks.
Thank you. Appreciate it once again. So this is going to conclude this week's podcast of Landlording for Life. As always, thanks for tuning in. We'll see you next week with the next episode. In the meantime, keep landlording. We'll talk to you soon. Bye-bye.
Thanks for listening to another episode. If you like what you heard, leave us a 5-star review and join our Facebook group to share your deals and ideas by searching at Landlording for Life. See you next time.